Hello, good morning. Welcome to the discussion of US international taxation. Today, our discussion will be who is liable to file tax return, on what basis, what is the due date, and various filing statuses which are prevailing in United States of America. So let's move into the first part. Who is required to file return of income? Any person whose income, because it's an income tax, exceed the maximum amount which is free from tax. So I'm interested what is the maximum amount up to which no tax is required to be paid. That is a standard deduction limit. That is a lump sum, a blanket amount provided by the United States of America. Any person's income below the standard deduction limit, then the filing requirement will not be applicable. However, if any person's income touches that standard deduction limit, that is the blanket lump sum amount limit, then such persons are required to file the return of income. Standard deduction for the normal people, it is known as regular standard deduction. Then the US government giving consideration for the senior citizen, means a person who has attained the age of 65 or more, or those handicapped, the blind people, they giving the additional limit. Considering these two together, normal person, the regular, and have certain condition of age and this blind, giving the additional limit, clubbing together, if the income touches or greater than those limit, then such peoples are required to file the return, US tax return. Next, we will move into the due date. Before moves into the due date aspects, we should understand the tax year. Tax year is a calendar year, is running from 1st January, is ending on 31st December of the concerned calendar year. Then when the tax is required to be computed, when the return is required to be filed, the due date, when is the due date? Due date for filing US tax return is April 15th. In other words, after completion of the calendar year, 3 months and 15 days grace period is there, by which the individual has to remit the tax on or before April 15th. 3 months, 15 days grace period for remitting the tax to the government. Then normally the return due date will be the April 15th. However, certain busy peoples or some peoples could not be able to file the return of income. Then what will be the solution for that? Provided the taxpayer has paid the tax, then by filing a form called 4868, it is not an automatic, has to require to file a form for extension of 6 months. Then up to October 15th, we will get the time for filing return of income. Though the name is automatic, this name is automatic extension of 6 months, but they are required to file a form 4868, and the ITR return number is 10040 return. Next, we will move into the different type of filing status which is available in United States. There are five type of filing status, five type of returns which is prevailing in the United States. Single, unmarried is a based on the marital status, whether married, unmarried, or the that basis. So it's called the single or unmarried return. Second, married return. Married people have two options. They can file, husband and wife can file a single form 1040 return, or they may choose to file return separately. What the advantages for filing the return is they will get the double deduction, standard deduction limit. They will get lot of other benefit will get for joint returns. Single return, the benefits are compared to less. It's a second status. Then qualifying widower is the third status. Then the last one is head of household. This is a name we have to understand now and moves the clarity for the discussion. Who is single? Single by default is an unmarried person or maybe married before, legally separated, divorced. When, what date that person should be single? The US taxation IRS giving year end test. By the end of the year, a person is unmarried or a person is legally separated. End of the year. Then he will be regarded as single. Return filed by such persons are treated as single return. Next, our discussion moves into the married. Who is a married? End of the year, 31st December, if a person is married or a person, US has a different culture system or different system of marriage, living together in a recognized common law of marriage. Second, third, married but living apart. They are married, but due to some clashes, feuds between the couples, they are living apart, but legally not separated. Then still the status can enjoy married status. Such case of things, those people living apart mostly will file what kind of return? They won't file joint return because already they are living apart because of the feud. So this is one example, married filing separately, or certain incomes, illegal incomes, or certain income one partner does not want to disclose with other partner. In such circumstances also, they will file the return separately. Married. When married filing singly and the married filing the return separate basis. The second category, married, two segments we have covered, and now we are moving into the qualifying widower. During the course of marriage, the spouse may be expired. There may be the children's on such relationship, and those couples whose spouse has expired during the tax year, they are widower actually. They are widower. They have certain burdens of the depending children. For taking care of them, their needs, the United States of America giving double standard deduction. How a joint return, how a deduction, a benefit is available on joint return, double standard deduction. the same benefit provided to them and will be taxed on that basis for 2 taxable year, only 2 taxable year after the death of the partner, any of the spouse. Then what will happen after 2 years? Either that person has to remarry or those status will be lost. And why US government is paying such benefit is to taken care of dependent children. There may be the children on the such a relationship, so the depending children's needs, they have to contribute more than half of the living expense of the depending children's. For that purpose only, such additional benefits are giving. And let us move into who are the depending child. Depending child may be the own biological child, or those don't have babies, they may be adopted child or stepchild. And we should understand this depending child has to stay with the taxpayer for throughout the taxable year. It's a mandatory. If not fulfill such condition, then this benefit will not be available. Dependent child exclude the foster child. We should understand the things. Foster child, any disaster or any war, orphan children, there may be some peoples and agency trained for taking care of such children. They are giving handovering the children's responsibility taken care. For that they will get some money from this agent or the person who taken care. It's a caregiving services for children, so they're getting additional benefit. So the foster childs are excluded from our purview. Then next we will move into the head of household. As far as the qualifying widower is concerned, the partner expires. Other cases, the married people, unmarried people will be there. Married people legally separated. Lot of complexities in a marriage relationship seems to be. There may be the, as we discussed, the dependent children will be there, dependent parents will be there, and this person maybe have the headache taking care of the responsibility for a house, expenses of the household. They have more expensive for taking care of caring others. The government gives some benefit, larger basic exemption limit. If the basic exemption limit is larger, tax liability will be reduced. That will be used for taking care of either the dependent children or the dependent parent. But the eligibility is that person should be unmarried, legally separated, single status holders, or last 6 months from the end of the taxable calendar year, these couples may be living apart. This divorce process anyhow requires 6 months. Then only they will grant the divorce. Those process, the couples are required to be live separately. Such person also eligible, provided they have a dependent children or dependent relative. For taking care of their needs, this larger tax standard deduction limit and wider tax brackets are provided. These dependent children or this dependent parents is not required to live with the taxpayer out of more than 6 months. That condition is giving here, more than 6 months is required to be live with the taxpayer. Qualifying widower, this throughout the year condition is there. Here the condition is only for the more than 6 month period. And definition of qualifying child, it is being different from the definition of this qualifying widower. Foster childs also allowed. brothers and sisters on those less age 18, 19, less than this age limit for taking care of them. Dependent parents will be there. For that, for that, this US government giving certain limits. Let's now move the final part. Dependent parents not required to be stay with live with the taxpayer. Why? Because these parents living with this taxpayer, or these taxpayers maybe have job on some other place. The parents, dependent parents, may be aged. They will be giving on these caregivers, or caregivers will come homes. They need more care, and we people are busy with the work. So for taking extra care, they maybe leave different places, provided the cost of upkeep. The taxpayer gives this more than half of this cost of this upkeep. Then dependent parents may leave separately. In other cases, the people, dependent child and relatives, record to be live with the taxpayer. So we are concluding on our discussion here, and thank you for watching this video.